Hello, everyone, and welcome back to the Trader's Mindchat show. I'm back after a brief hiatus, but I think it's a great time to come back because now the market is finally moving. And there are a few names that are starting to break out. If you've been patient, you've been sitting in cash, and then suddenly watching the green, or in my case, orange, because I don't like the casino feel of most of the charts. So I changed mine to orange and gray. Watching those bars fly by on the screen while you're flat, that's actually what I think is one of the hardest moments in trading, because it's not just FOMO or the fear of missing out, it's the self-doubt. You start questioning your plan. You wonder if you missed it. And the truth is, this is exactly the moment when discipline gets tested the most. So, if you've been feeling this tension lately, then today's episode is for you. So, go ahead, type into the chat. Let us know where you're at, where you're from. Let us know if you felt that kind of tension today, because if you've ever felt that kind of tension, know that I'm right there with you. I've felt that tension many, many times before. And hopefully, in this episode, we'll walk through and you'll have some takeaways of how to make that start to be a thing of the past. So, here's the reality of the market that we're in. Now, let's get the charts up and going here and take a look at things. All right, so right now we are looking at a picture of the New York Stock Exchange. Let's actually pull up the NASDAQ. I think most people are following the NASDAQ. So this phase right after this period of chop, and we've basically been in chop since February, where we just started to fall and fall further, slice right through that gray line, the 200-day moving average, continue to work its way back down a little bit further, pause for a little bit, and then roll right back over. That's actually a little bit more of the easier time to sit out, because in that time, there's like next to no setups, nothing's working. And then all of a sudden in here, you start to get this big rally. And then all of a sudden you have the biggest up day, that the biggest point wise that the NASDAQ ever had. Up, I think, what was it, 1,800 points on the day, somewhere in that ballpark. And then percentage wise, I think they said that it was the second largest with a 12% move on the day. Crazy. And you start to think, oh man, I missed the boat. So what do you do? What do you do? And then you start to wait a little bit. You start to see some setups working. Some stocks are starting to break out. But the truth of the matter is, the market as a whole is not fully aligned, at least not yet. And this is where a lot of the traders, even the good ones, start to get pulled off center. One of the things that I like to do that helps me to stay on center at all times, and if you've been to this show before, you know what I'm about to say. I like to look at the market through these three lenses. By looking at the market through three lenses here, we have the general market, your system, and your personal performance. That's giving you a three-dimensional look. And at the center of it all, that's what's going to be your traffic light, or what I like to call the market mood, where you'll be able to easily spot, well, are things getting better overall, or just in this one little area? Should I be stepping on the gas, or should I be hitting the brake? Well, as you gather the data from all three lenses, that makes that whole decision-making process a whole lot easier. And guess what? You could tie all of this, general market, your system, or think of it as the stocks that might be passing your screens and how they're setting up. Are they making progress or are they not? Are you seeing quality setups or are you not? And then your personal performance, you could tie all that to your position sizing. and you could start to use what's called progressive exposure. A lot of people have talked about progressive exposure. A lot of people that have come before me that are much better. Uh, the person that I learned progressive exposure from, primarily two people, Mark Minervini being one of them, Van Tharp being the other. The way that I like to think of progressive exposure in context is to think of it like this, where if we're still in this red zone where things aren't quite turned yet, maybe the markets are still overall on a downtrend, maybe they're below some key moving averages, that might put it into a red zone. Maybe you're not spotting high quality setups. Things might be moving, but there's a difference between stocks moving and it being an actual high quality setup. Yeah, the ones that give you high reward and low risk, right? Versus maybe some of what we've seen lately, which is giving us high reward, but also high risk. All those things can play into this traffic light system. And when you start to gain some traction in the market, then that would be the time to start to scale up. I have some of the ways that I scale up over here. If you want to take a screenshot of this, feel free and go ahead. But this is what I do. So right now, we're in the earlier stages, but it's important to remember that we are in the earlier stages. Here's the market again, starting to come off the low. So am I putting on some trades? Yeah, I am. Starting to get involved. There's plenty of spots where maybe we start to hit a little bit of resistance, right? There's that red line that's coming off the top over here. That's that 50-day moving average, the one that the major institutions of the world tend to look at. Then there's this gray line over here. That's the 200-day moving average. That's where a lot of the major players tend to look at that one too. What I've got my eye on is not just the 200-day moving average, but also this point back here from March 25th. If you notice, that's where price had started to come down before that, rallied back up, and then it stopped, right? And then it started to fall. So when price gets back up to this level again, it's likely that you'll find some sellers in there. So I would be very curious to see how the market reacts to those different levels. This 50-day moving average, that red line, as well as this level from back in March, which coincidentally lines up pretty good with that gray line, the 200-day simple moving average. But I've talked to a lot of traders this week. People in our accelerator program, people in X and on StockTwits. Some people are saying that, you know what? I feel like when the market's like this and we're starting to see stocks break out and maybe a stock like a Palantir breaks out and it's up. I don't know. Well, what is Palantir up today? I think it's up maybe about 4 or 5% or something like that. Well, let's see what Palantir is doing. Oh no, it's only up 2.5%. See stuff like that. You see it on the weekly chart, and the weekly chart. Oh man, this stock is up 17% on the week. I feel flat-footed. Maybe I should be doing something, but I'm not sure what. That could be problematic. I think that there's a couple of things to tease out of this. The first thing is that we want to assess reward to risk. We always, whenever we're putting on any kind of trade, we always want to be thinking about it in terms of reward to risk. So what did you need to risk in order to put on this trade? Depending on your style, maybe yours is a little bit different than mine, but for my style, I would want to get in right at around here, right at around $99.10. Caleb, I see that you're in the chat. Caleb actually got into this trade a touch higher, I think $1 or $2 higher, but he's in this trade, and this trade has run up pretty well for him, and his stop is at break even already, and he's free rolling this trade. So well done, Caleb. The way that I would have traded this, and this is why I'm not in this one. My style's a little bit perhaps more on the conservative side. I'd be looking to enter at roughly the same spot, but my stop would be all the way down here at $88.90. That would mean that I would need to risk about 10% on this trade. So in order for me to just make 1 times my risk, I need this thing to move about 10%. Doesn't feel so good, right? Like if you're given, if it's a 50-50 shot, right? Like if we're looking at this as a coin flip, win a dollar, lose a dollar. I don't really like that. And I also don't really like having to make 20% on a trade just to get 2-to-1 reward to risk, which is what I like. So that's why, for me, I passed on this one. But if I would be remiss if I would say that, oh, well, this is the only trade. Here's another trade that I took a couple of days ago that fit my reward to risk a little bit better. I think that there's certainly a few accelerator members that followed me into this one. A few of our research program members too, because I like to play with an open hand. Everybody gets my my trading plans sent to them the evening before. In today's case, it was sent out this morning at about 7 a.m. Eastern. But with Netflix, it fit my reward to risk a little bit better. Here's why. On this one, I only needed to risk 5% between where I was looking to enter, right the middle of the W right there for this double bottom. That was at $1,001.10. And my stop down at 947.90, that meant that I only needed to risk 5.3%. And on this trade, overall, I'm looking for it to go to 1,200. So that gave me a reward to risk ratio of 3.74 to 1. I like that a lot better. Risk a dollar, make almost $4. Great. So that's a trade that I did take, but it's more to it than that. Well, we could get into the weeds of all that other stuff on the chart, or maybe even the fundamentals if you guys have questions on any of that. But it, at least for right here, right? Know that this was a trade that I saw as an A-level setup, and I put that on. Wonderful. But here's the main point. Does one good trade equal market readiness? I don't think so. Just because Netflix broke out this week or some other setups might start to follow through, that does not mean that all of a sudden it's go time, step on the gas. And, that's actually, it's actually a common trap. It's a market seduction, if you will. And it's our job not to fall for those kinds of things. Here's what you might refer to this kind of market as. This is like the market tease phase, right? Where you start to see stocks starting to break out. You got your Netflix, you got your Palantir, maybe you've got a couple of other names that are starting to emerge, are starting to move. We're in still a high volatile environment, so things are moving on a pretty high percentage basis day to day to day. But it's in this tease phase. Why? Because you do have this 50-day moving average that right now, if you measure it from where price is at on the NASDAQ to the 50, it's only 2% higher. Right? It could get there on Monday and then all of a sudden pull right back, just like how it did when price tested the 21-day exponential moving average, that purple line, just a couple of days ago. Or when it tested it back on April 14th, hit its head, and then pushed right back down. Remember, the NASDAQ hasn't even touched the 50-day moving average since way back here towards the end of February. So it kind of makes sense that the first time that the NASDAQ goes and tests that line, it might back off. And that's where the market is in this tease phase where if we jump the gun, if we try to force trades, right? Like if it's not this high probability, high reward, low risk scenario, how I was seeing Netflix, if it's not that for you, if you're just seeing something moving and you're jumping in because you don't want to miss the boat, this is what happens, right? You could sabotage months of solid prep just trying to catch a move that your system wasn't built to catch because of all this overhead. And then if you end up trying to chase and then price hits resistance, starts to fall, pulls back on you, then that's where a lot of the second guessing of plans happens. It's where some people might start to say, oh, you know what, if I were sized differently, maybe I wouldn't have, maybe I'd be able to hold on a little bit longer. Was it that, or maybe it's the plan? It could be a bunch of different things, right? And we could spend all day trying to play these what if scenarios, but the way to just brush all that aside, just follow the path, right? Follow the plan. You don't need to worry about tons of other things. You don't need to worry about what stocks are moving. You don't need to worry about what somebody else is saying. You don't need to worry about a lot of stuff. All you need to worry about is just this much, right? Just that much. Just the part that fits your trading plan. If it doesn't fit your trading plan, then you don't need to worry about it. That's really why, like right now, why I'm in Netflix, because that one fit my plan. I added QQQ today. That fit my plan. And I'm not in anything else at all right now because all fell outside of the plan. So that is that. So you might be wondering, well, what do you do if you're just sitting on the sidelines? Well, here's a couple of stories, right? A couple of stories. Here's Daniel's story. So Daniel is one of our accelerator members. He's right now he's on day 10, I believe it's day 10 of a 30-day sprint where he is just super dialed in, accelerating his trading plan, his trading business plan. The market's moving, but he's not chasing, right? He might have been chasing a year ago, but he's not chasing now. Why? Because he's busy sticking to his process. He's busy researching, building out a model stock book, getting ready, getting prepared, making sure that if he spots a trade, that trade fits his model. And if it doesn't fit his model, right? And it's not where, oh, it has to fit it exactly. That we bake in some buffer, right? So say if it fits 90% of the model, maybe even 85% of the model, that could be close enough where you go for it. But there's a difference between fitting 85% of the model and fitting 40% of the model. But you do want to build something where you have a comparison, where you're able to pull up a chart and say, let me show you this, right? Here, take a look at this right here. Here is my model book. Some of you might have seen this before. I'll pull up this chart. Haven't pulled up this one in a while, right? So this is a chart of a cup with handle. I spot something close to this setting up, I'm able to take what I'm seeing in real time, compare it to this chart back here of Zillow from, I think this was 2018, and say, is this close? Well, yeah, it is. Awesome. Then I could go for it because it's following the model. But if it's not, if there's a bunch of flaws, then I know to pass. But right, like, so you could build out a whole book of these, not just one, and those are the kinds of things that will help you as the market starts to move, as the market starts to take off. And that's what you could do in your time versus trying to say, oh, I need to catch this move because the market's up X%. Well, if you're doing work like this, where you're doing, say, a model book study and you're building it out, you'll be able to catch the one that's actually closer to the ones that tend to move. And not only that, it'll help you filter out the noise of everything else. So you won't be over trading, right? Because you're following the model. You'll be taking the higher probability trades because you're following the model. And you'll be a lot less stressed because you're not busy wondering, oh, did I miss the move? Well, was this one similar to the model? Yes or no? And if it was similar to the model, then you might also have done a larger model study where you realize, oh, this isn't a once in a lifetime trade. This actually pops up fairly frequently. So all I need to do is just start paying a little bit more attention, and then I'll just at the next one, right? You miss one bus, you just hop on the next one. This is the core idea. Discipline is not about waiting. Discipline is the preparation without the impulse. Does that make sense? Discipline is the preparation, getting your plans together, building out your model book, knowing what the market condition is, right? Doing this kind of work where you know what the general market is, you know what your system is producing, you've studied your personal performance, you've identified your trade, you know where you're going to get in, where you're going to get out, where you're going to cut a loss. You've pre-planned your sizing, all that kind of preparation without the impulse of just seeing the market move and saying, I've got to get in right now. That's what discipline is. You're not sitting still. You're busy sharpening. You're busy refining. You're respecting the market. I'd like to issue a challenge to you guys before we open it up to the Q&A. And I see that we've got a whole bunch of people on board with us. Welcome everybody over from X, from YouTube, and over on Twitch. Welcome, welcome. Get your questions ready. Go ahead and start typing them into the chat if you have anything that we, questions on anything that we covered or anything else that's trading related. Go ahead and start getting that into the chat right now. But I'd like to issue you guys a challenge for this weekend. Take 10 minutes, just 10 minutes, and ask yourself, if I'm not in this market, is it because I missed something? Or because maybe my setup hasn't shown up yet? Think about that. If I'm not in this market, is it because I missed something or because my setup hasn't shown up yet? That one question can tell you if you're in alignment or if fear is in the driver's seat. Let's see, any questions coming in? Not yet. All right, let me get a sip of that. So let's see. So if you've been watching this market, let me pull up market again. If you've been watching this market and wondering, Am I missing the move? Maybe the better question is, right? And let me pull up the chart here. There it is. Now you can see it. So if you've been wondering, am I missing this move? Maybe the better question to ask is, do I have a business plan for this? Do I know what tells me when to act? That's what traders do through their business plans. And it's one of the reasons why I wrote that book, the Trading Success Blueprint. That blueprint, it's not a course and it's not like other books. It's a framework to help you turn your trading into a business, one that runs on clarity with not emotion, something that is going to help you turn a trading hobby into a trading business. The key difference between a trading hobby and a trading business is that you have a structured plan in place for every part of your trading. Under what conditions are you going to get in? Under what conditions are you going to participate? What setups are you going to be taking? Have a definition for those kind of setups. How about your position sizing strategy? Do you have emergency plans for if the lights go out or if you can't log into your broker? All these kinds of things too, the kinds of things that people generally don't think about. All that needs to get baked into your business plan, because if you're one of these people where, no, it's the middle of the day at work, oh man, well what's my trades doing, just like kind of flipping through stock twits or wherever you log in, maybe you're flipping through Robinhood and you just kind of check it in on it casually. That's where most people are. That's where I once was too. It's not the kind of trading that leads to long-term profitability. The kind of trading that leads to long-term profitability is to have processes in place, to have a business plan in place, something that you're actually following, something that you believe in and rely on. Like, and I'm not just talking like the kind of the hopeful praying where you just like you don't kind of, but you just kind of wishing. This isn't about wishing on a star. This is about something that you actually know will work because you've laid the foundation. That's what the Trading Success Blueprint does. And if you're interested in that, I'll drop the link for it. But let's, again, open this floor up to some Q&A and we'll get that going too. All right, here's a question about the trade in triple Qs. Let's pull up the triple Qs again. All right, question. I know the target is about $500, but do you have a scale out point for that? So here is question is from Daniel, one of our accelerator members. So with triple Q, if price is able to get to the $500 target, then that would give us twice my risk. And so that's where I would be looking to scale out. Would I scale out beforehand? I would actually start to scale out a little bit earlier. Perhaps at around 492 and change. More like 1.5 times the risk on this one. The reason why it's a little bit different is because we're getting to that overhead supply. The purpose of this trade, this particular trade, as opposed to some of the, like a standard trade that I put on, like a Netflix. The reason why I put on triple Q is to start to gain exposure. Right now, the market's in that little bit of a transitional spot where We're starting to move from the way that I see it, we're moving from a red to an early yellow condition. The reason for that is because markets are starting to improve, the general market, right? We're looking at each of the major indexes, like I like to look at. Each one of them is starting to climb back above its key moving averages, namely the 21-day exponential moving average. We're starting to see stocks starting to move, stocks starting to set up a little bit better, some stocks starting to break out and make some gains like Netflix. Personal performance, I've made some traction in my portfolio. Netflix is up about 10% or so since I bought it. And let me see that. How much is it up at? Yeah, about 10%, a little bit over 10%. I was able to take my first scale out on Netflix, get my stop to break even. That's free rolling the trade. So as far as these three lenses of market readiness go, yeah, we're starting to turn into an early yellow. So I asked myself, are there stocks that I wanted to buy today, right, to add to it? Well, it's a Friday, and Fridays tend to be kind of funky days, right? When I take a look at all of my past trading data, one of the things that I look at are what days are trades initiated and how do those generally work out. When it starts on a Friday, it's not one of the better days. It doesn't mean that I shouldn't trade on Friday, but I want to be sensitive, even more sensitive than normal, to the quality of the trade. So I wanted to add some exposure today because the market is turning, but did I see anything that met that higher qualifier? I did not. The closest one on today's list was Fortinet. I decided not to take that one. But I did take QQQ to add that extra little bit of exposure. And so that's what I did with that one. And that's also why I'm willing to scale out of it a little bit differently than what I normally would. The risk on this one is about 3%. My first scale out on this one will be at about 5%. And yeah, I'm willing to hold it for longer if it does continue to move up. But this is more like a placeholder versus what I would consider a true position. And if we start to get more stocks, more leading stocks that I like to trade setting up next week, that's what I'm looking to start to get into. And if I've got to cut something to make room, I'll be cutting this. Excellent question. All right, so it looks like that is about it for today, and we're at the end of the session. Time flies when you're having fun, right? So I hope that you found that valuable. If you did, let me know, and I hope that you'll take the challenge that we laid out for you this week. Remember, this week's challenge, take 10 minutes. Ask yourself, if I'm not in this market, is it because I missed something? Or was it because my setup hasn't shown up yet? Think about that. That one question can tell you if you're in alignment or if it's fear that's in the driver's seat. See you guys next week. Take care, much love, and as always, God bless.
Hey, thanks so much for sticking around to the end. If you're new here, hit the subscribe button down below and become a part of the Merrill Wealth community. And make sure that you check out some of the other videos on the channel. They're exactly what you need to see. And leave a comment down below. I read all of them. Leave a comment.